If you are still sitting in the same portfolio that made sense when money was free, I want to tell you something uncomfortable. You are not being conservative. You are being outdated. And outdated is a very expensive condition when the whole monetary regime has changed underneath you. For years, people were told a simple story: own stocks, own bonds, hold a little cash. Wait, the market will do the heavy lifting. For a very long time, that story worked well enough that hardly anybody bothered to question it. It worked because the background music was doing most of the work. Interest rates sat near the floor, money was cheap, debt was easy, liquidity was everywhere, asset prices floated higher together, stocks went up, bonds went up, real estate went up, private markets went up. Everything went up because the measuring stick was being softened year after year. Almost nobody wanted to say it. Plainly, that world is older now, more tired, more dangerous. And if you are still managing your life, savings, as though that world is alive and healthy, then you are exposing yourself to a risk you probably do not fully understand. That is the part I care about. Not whether you can squeeze out one more exciting year, whether you can protect what took you 30 or 40 years to build, because there is a difference between investing to get rich and investing not to get carried backward. And a lot of people are about to learn that difference the hard way. If you want the mother line for everything I am about to say, here it is. The most dangerous thing in a late cycle debt regime is not owning the wrong hot stock. It is trusting an old protection system that only worked because rates were falling, debt was cheaper, and the currency could be quietly weakened without most people noticing. That is the line. That is the thing I want fixed in your mind. Because once you understand that, the whole conversation about safe investing changes. Most people still think safety means familiarity. That is wrong. What feels familiar can become dangerous when the system it depended on disappears, and what looked boring for years can suddenly become the only honest shelter left. That is why I want to talk about protection, not prediction. People love prediction because it flatters them. They want to know the date of the crash, the exact catalyst, the perfect entry point, the best headline trade. I do not care about that game. I care about what kind of assets survive a world where debt is too large, rates cannot return to zero without consequences, inflation is politically toxic, and the old 60/40th religion stops protecting people the way it once did. That is a much better question. Now let me tell you what changed. I call the first mechanism the free money hangover. The free money hangover is what happens after a country spends years suppressing rates, expanding money supply, rescuing asset prices, and teaching everyone to believe that financial gravity itself has become negotiable. Definition is simple. The system got used to conditions that were never normal. Then it mistook those conditions for a permanent birthright. That is what happened. After the great financial crisis, the policy response was not cleansing, it was cushioning. The central bank took rates down to the floor and kept them there. Bond buying became normal, liquidity became routine. Every time stress appeared, policy learned to rush in and make the environment easier again. That did not just save markets. It trained markets. It trained companies to finance themselves more cheaply than they should have. It trained households to think lower rates were a law of nature. It trained governments to borrow with less shame than arithmetic deserved. And it trained investors to believe that bonds were still the harmless old ballast they had been during a 40-year disinflationary tailwind. That is the hangover. The pain does not begin while the party is happening. It begins when the system tries to function without the same dosage and discovers it cannot do so gracefully. That is where we are now. The old playbook relied on a background condition people did not value correctly, falling or ultra-low rates. Once that condition changes, the whole machine behaves differently. And because most portfolios were built in the age of easy money, they are holding assumptions that may already be broken. That is why the average person feels confused. He thinks, I diversified maybe. But diversification only protects you if the pieces respond differently under stress. If the old regime changes, old diversification can become synchronized pain. That is a very nasty surprise for somebody near retirement. And near retirement is where this becomes lethal, not merely inconvenient. A young person can survive a decade of foolishness and call it education. A retiree can turn the same foolishness into irreversible damage. That is why I am being so direct. Now let us move to the second mechanism. I call it the fiscal cliff without an edge. This is where the story stops being about markets alone and becomes a national arithmetic problem. The fiscal cliff without an edge is what happens when government debt becomes so large that the interest burden itself starts competing with every other priority, while the political system still behaves as though debt is an abstract problem for another decade. That is nonsense. Debt is never abstract when the bill starts arriving, and the bill is arriving. $1 trillion a year in interest is not a slogan. It is not a dramatic phrase for television. It is money gone. Money spent not on growth, not on infrastructure, not on productive investment, but on the privilege of having borrowed too much in an easier era. That matters. It matters enormously because once a government reaches this scale of debt, it loses freedom. Not political rhetoric freedom, real freedom. freedom to tolerate high rates, freedom to roll debt painlessly, freedom to pretend it can fight inflation with old-school severity and no collateral damage. Freedom to promise everything to everyone. When the debt gets this large, every policy choice becomes a debt choice too. That is the part many investors do not understand. They still imagine fiscal irresponsibility as something that matters in theory. It matters in asset pricing. It matters in the bond market. It matters in the future purchasing power of savings. This is why I have always cared more about the structure underneath the numbers than the soothing language wrapped around them. If a country has to keep refinancing immense obligations into a higher rate environment, then the bond market is no longer a background detail. It becomes one of the main battlegrounds. And when the bond market becomes a battleground, safe changes its meaning. That is what I want you to see. People still hear government debt and think politics. I hear it and think duration risk, currency pressure, forced financial repression, and the rising temptation to solve deep problems through quiet debasement instead of open pain. That is not conspiracy. That is history. Governments with too much debt rarely become saints. They become creative. And creativity in government finance is usually bad news for savers who trusted fixed nominal claims too much. Now let me show you the third mechanism. I call it the duration trap. This one is where many respectable people get hurt. The duration trap is the belief that all bonds are safe simply because they are bonds. That was lazy thinking in the old regime, and it is dangerous thinking. Now, definition is simple. A long bond is not safe just because the issuer is safe from default. If rates rise, a long bond can lose a great deal of market value before maturity. That is not theory. That is math. And math is very unromantic here. If you own a long-dated bond in a world where yields rise meaningfully, the price damage can be severe, very severe. This is what so many retirees and near retirees do not understand, because they were trained by a 40-year tailwind for decades. When stress appeared, rates generally fell. When rates fell, bond prices rose. So people came to believe a bond allocation meant protection. Sometimes it did, but it did because the regime supported it. Now imagine a different world. The inflation problem is not fully dead. The fiscal problem is getting worse. The central bank cannot simply drive rates to zero without risking another fire. And yet the economy is weak enough that investors still want to call bonds safe. This is how the trap works. You take an asset that only behaved defensively under one set of structural conditions, and you keep holding it as though those conditions still rule the world. That is not prudence. That is habit. And habit can be fatal in money. I want to say this as clearly as I can. A 30-year bond is not a hiding place in an inflationary or fiscally unstable regime. It is an opinion, a very large opinion, an opinion that rates will fall, inflation will be contained, and the system can absorb that duration without violence. Maybe that opinion will work at some point. Maybe, but do not call it safe and expect me to nod politely. Safety is not a label. Safety is context. That is why I do not lump all bonds together. A short treasury bill is a different animal from a long-dated nominal bond. One gives you flexibility, the other gives you exposure. One lets you roll forward as rates change. The other traps you in a long commitment to a fixed stream of payments while the world may be repricing the value of money itself. Those are not the same thing. And when an advisor or a retirement article lumps them together under the same comforting heading, I know I am reading something designed to calm rather than clarify. I prefer clarity. Now let us move to the fourth mechanism. I call it the silent theft. This is the real reason I care about gold, hard assets, and the purchasing power problem so much. The silent theft is what happens when a government cannot politically reduce its obligations enough, cannot tax enough without revolt, and therefore leans over time toward debasing the currency rather than confronting the problem honestly. That is the theft. Not a man with a mask, a system with a printing bias. People hear the phrase currency debasement and think it sounds dramatic. It is actually quite ordinary. The currency buys less over time. Nominal values may look stable. Your account may not appear to be collapsing. The government may even tell you inflation is under control. And yet what your dollars command in the real world keeps shrinking. That is the theft, quiet, gradual, brutal, especially to savers. Gold matters here not because I think of it as magic and not because I need mythology in my investment process. Gold matters because it is one of the few monetary assets that sits outside the direct promise structure of a government that can print more of its own liabilities. That distinction is everything. People love to say gold is an inflation hedge. That is fine as far as it goes. It does not go far enough. Gold is not just a hedge against prices going up. It is a hedge against the trustworthiness of the measuring stick going down. That is bigger. That is why central banks buy it when they become less comfortable with the reserve architecture. That is why I would rather own some part of my protection in something that does not depend on a committee preserving my purchasing power with saintly discipline over decades. because committees do not age into sainthood, they age into pressure. That is the silent theft, and if you do not respect it, you will wake up one day with assets that look fine in nominal terms and discover that what they can buy for you in the world that matters has been quietly gutted. That is a bad surprise. Now let us move to the fifth mechanism. I call it the pricing power shield. If the first part of protection is defending against debasement and duration damage, the next part is much more practical. The pricing power shield is ownership of businesses that can raise prices without losing the customer base they depend on. That is one of the most valuable qualities any business can have in an inflationary or fiscally unstable regime. When costs rise, most weak businesses suffer. They eat the costs and margins collapse, or they raise prices and customers flee. Both are bad. A business with real pricing power is different. It can pass through higher costs. It can preserve margins. It can keep generating cash while the broader environment gets rougher. That is what I want near my money when the world becomes less polite. Now think carefully about which sectors live there. Healthcare, consumer staples, some energy exposures, certain dominant businesses in essential categories. These are not glamorous because glamour has nothing to do with the point. The point is endurance. People do not stop needing medicine because growth slows. They do not stop brushing their teeth because rates rose. They do not stop buying basic household goods because the bond market is having an existential argument with the Treasury. That is why these areas matter. Demand is not infinite. Nothing is infinite. But it is more durable. And durability is one of the rarest things in late cycle investing. What I do not want is a giant pile of speculative businesses whose valuations assume the return of free money and whose customer bases can disappear the moment the economy loses its smile. That is not defense. That is hope. If a company requires a perfect environment to justify its multiple, its financing, and its growth story, then it belongs nowhere near the core of a protective portfolio. Not if you are trying to survive a nasty macro turn. That is why I dislike the way people still talk about safe growth as though every wonderful story with a huge price tag is somehow conservative because it used to go up a lot. A business can be exceptional and still be a terrible defensive holding if the valuation and macro assumptions around it are wrong for the regime. I want earnings that matter today, products people keep buying, and management teams not living on borrowed optimism. That is the pricing power shield. And in an ugly environment, it often matters far more than cleverness. Now let me give you another mechanism. I call it the retirement asymmetry. This is the one people near retirement have to understand in their bones. The retirement asymmetry is the simple fact that a market crash does not hurt a 35-year-old and a 67-year-old in the same way. Even if the percentage decline is identical, that matters. A young accumulator can keep buying. He can use lower prices. He can wait. A retiree taking distributions cannot treat a 40% drawdown as a philosophical inconvenience. He may be forced to sell assets at the wrong time to fund actual life. And once he sells at the wrong time, those losses are not temporary the way young investors like to pretend all losses are. They become locked in. This is why sequence risk matters so much in retirement. Returns are not just about how much you make. They are about when you make it and when you are forced to spend it. A beautiful long-term average return does not save a retiree whose first years of retirement line up with a brutal drawdown and poor protection. That is the asymmetry. And it is why I care so much less about maximizing upside in this kind of regime than many younger, louder investors do. If you are 28, you can afford a lot of stupidity and still recover. If you are 68 and drawing on the portfolio, your margin for fashionable mistakes is much smaller. That is not pessimism. That is context. Once you understand retirement asymmetry, your whole portfolio construction process becomes more honest. You stop asking, what could triple? You start asking, what can preserve purchasing power, produce reasonable returns, and avoid catastrophic sequence damage while the regime is unstable? That is a much better question. Now let us turn all of this into actual protection logic. If I were looking at a portfolio that had not really changed from the old zero-rate era, I would think in three layers. The first layer is monetary defense, gold or hard asset exposure. Not because I worship metal, because I distrust the long-term discipline of a highly indebted system with political incentives tilted toward easier money over time. The second layer is low-duration liquidity, short-term treasury bills, very short-term government instruments, perhaps inflation-protected securities where appropriate. Why? Because they let me earn something while preserving flexibility. They do not force me to make a giant long-duration bet on a regime that may not reward it. Flexibility is underrated, massively underrated. The third layer is ownership of real businesses with pricing power and durable demand healthcare. Consumer staples, selected energy, strong cash flow, real earnings, lower dependence on fantasy multiples. That is what I want. Not because it feels thrilling, because it feels survivable. And survivable is a very useful quality when the rest of the market starts discovering that old protection systems may no longer protect the way they once did. Now let me speak about gold implementation plainly, because people often complicate the issue. There is physical gold, there are straightforward gold ETFs, there are mining stocks, which are really not the same thing and should not be confused with direct metal exposure. Physical has no issuer risk but is less convenient. A large liquid ETF is easier for many portfolios and retirement accounts. Mining stocks can amplify moves but bring company risk, political risk, cost risk, and operational risk. These are not interchangeable. Again, context matters. If your purpose is monetary insurance, own the form of exposure that actually reflects that purpose. Do not mix insurance thinking with speculation vehicles and then act surprised when the behavior differs. The same principle applies to bonds. If your purpose is stability and dry powder, keep duration short. Do not wander into long-dated paper simply because someone told you bonds are safe. That sentence is so incomplete it should be illegal. Bonds under falling rates behave one way, bonds under inflation and fiscal strain behave another. Know the difference or pay for it. Now let me speak about pricing power implementation. You do not need to know every healthcare company on earth. You do not need to become a specialist in detergent economics. What you do need is enough honesty to ask whether the businesses in your portfolio can protect margins when costs rise and demand weakens. If the answer is no, then stop flattering yourself that you are diversified. Just because you own many tickers, owning many things that all need a beautiful macro environment is not diversification. It is distributed wishful thinking. I do not want distributed wishful thinking in a regime shift. I want real defense. Now let me make the identity flip explicit. Most investors still think their job is to maximize return in a spreadsheet. That is not always the right job. Sometimes the real job is to preserve irreplaceable capital while the world transitions from one regime to another. That is a very different identity. A young accumulator can think in terms of decades of additions. A retiree or near retiree must think like a steward of irreplaceable chips. Once you accept that, a lot of seductive nonsense stops working on you. You stop chasing glamour. You stop worshiping the hottest stocks of the last cycle. You stop confusing long bonds with peace of mind. You stop waiting for the old playbook to become valid again, just because you liked how it felt. And you start doing what serious capital always does in dangerous transitions. You become selective. You become defensive without becoming dead. You become cautious without becoming paralyzed. You become willing to own boring things if boring things are the honest answer. That is wisdom, not cowardice. Wisdom. Now let me tell you the operating system I would want you to use first. Admit the regime changed. If you cannot get past that step, the rest is useless. Second, identify any long duration exposure that only made sense when rates were falling and inflation was tame. Third, distinguish between cash, like safety, and long bond risk. Fourth, build a hard asset hedge against fiscal irresponsibility and currency debasement. Fifth, emphasize businesses with real pricing power and essential demand. Sixth, remove or reduce speculative growth positions whose valuations still depend on a cleaner world than the one now in front of us. Seventh, remember that near retirement, avoiding large permanent impairments can matter more than squeezing out one more hot year of upside. Eighth, stop asking what used to work best and start asking what survives the regime we actually have. That is the operating system. It is not complicated. It is just honest. And honesty is rare in financial planning because honesty usually feels less exciting than optimism. I would still rather have honesty. Now I want to say something personal in tone even though the logic remains cold. A lot of people who are close to or already in retirement did what they were told for decades. They saved, they contributed, they diversified, they trusted. That was not foolish. It was reasonable in the world they were living through. But the hardest part of investing is that sometimes a reasonable strategy becomes dangerous, not because you were stupid, but because the environment it depended on no longer exists. That is not a betrayal by the universe, that is adaptation. And adaptation is not optional. Not if you care about the life your money is supposed to support. You do not need to panic. Panic is always a confession of having waited too long. But you do need to move honestly. If you are still sitting in the same exact portfolio you were sitting in when zero rates, endless liquidity, and the old bond-stock relationship made life feel simple, then you owe yourself a colder look, not later. Now, because once a crash or deeper regime break is obvious to everybody, the easy adjustments are gone. The window closes fastest for the people who needed protection most. That is why I care about this so much, not because I enjoy fear, because I dislike avoidable ruin. Now let me put the blade into this as cleanly as I can. The next crash will not hurt people most because they failed to own the hottest winners. It will hurt them because they trusted the wrong things to be safe. Long bonds that are not safe in this regime Cash that silently erodes if you overstay in it. Growth stories priced for a world that may not return soon. A portfolio designed for falling rates in a world defined by debt, inflation pressure, and fiscal compromise. That is the real danger. And the answer is not hysteria, it is repositioning. Hard assets that defend against debasement, short duration instruments that preserve flexibility. Real businesses with pricing power and durable demand. That is how you protect wealth without burying it. That is how you stay in the game without pretending the old rules still run the table. And if you remember nothing else from what I said, remember this. Protection is not about hiding from volatility. It is about refusing to let an outdated playbook turn your life as savings into collateral damage for a regime that already ended. That is the job. Now, do it honestly, do it before the crowd, and do it with the respect that irreplaceable capital deserves.